Good. Okay. Well, good morning, everybody. I hope everyone had a pleasant Christmas and New Year. This is I guess, the next in our quarterly series of updates. Very much today, we're talking about interest rates. We're talking about what's going on in the American market. We're talking about inflation and how that's likely to impact on you and your portfolios. And I suppose to a certain extent, your kids and where interest rates are going to go. So I hope you enjoyed today. But as I said many times in the past, if you have any questions, please just ask or put a comment in the chat, and I'll see if I can respond to that while we're talking. So today's agenda: look at the markets and recent movement in the markets. We're definitely talking about inflation, interest rates, going forward, what it means, and looking backwards, what it's taught us. We're going to spend a little bit of time on quantitative easing, which is basically printing money and how that works in the market. I want to have a good hard look because as probably all of you know, I'm an avowed and very proud Australian. I think the numbers have just shown that we live in the best country in the world. I want to show that to you so we can actually take a spell and realise that life is actually pretty good here by comparison to just about everywhere else. So as always, questions at any time or at the end. We'll be lucky if I can keep this under 30 minutes, but it needs to be under about 45. You all understand the drill, so please toss a question in as we go, and I'll be able to see it and comment on it as I talk. I've got it on the screen in front of me. So proceeding. So just get the right buttons going. So we're going to have a look at markets now. Just a quick rehash. The stock market over the last the last 6 or 12 months has been, the last 6 months has been fundamentally flat to negative. This is the figure from the start of the year. It's fallen from about 7,600 down to about 7,200. That's a normal response to fairly strong inflation figures coming out of America. In and of itself, inflation isn't much of a threat to the stock market, but it does suggest that interest rates are going to start moving upwards in America. And that inherently has a short-term impact on the stock market. It's almost always short-term. We'll talk a bit more about that as we go. Now, if you look for the 12 months, we're still very much in positive territory. The recent blip in many ways would represent a buying opportunity, and you can see the market sort of bounced down when America started to talk about hyperinflation, which is an overcooking of things. I'll talk about that more as we go, but the market's bouncing back. Now, if there's a little bit of background noise, I hope it's not too disturbing. I want to show you these figures. This basically goes back to 2 years ago. Almost 3 years ago, February 2019, sorry, it is 3 years ago. We have seen COVID right in the middle here with this big blip, and we've seen a fairly strong recovery. Now, there is a structural difference between the Australian and the US stock markets. But the first point I want to make is the governments of the world started printing money about 2 years ago, and the stock markets have done exactly what they always do, which is to recover quite quickly. Now, I'll just let somebody in here. The difference between the blue line, which is Australia, and the orange line, which is the USA, is fundamentally. Ian, I might just get you to mute yourself if you don't mind. We can hear you talk in the background there.
That was Jill.
Sorry.
How are you, mate? If you wouldn't mind muting yourself, that'd be terrific.
Yep.
Let me see what I can do. I might even be able to help you. There you go. I can mute you for you. So in the US, historically, they don't pay much in the way of dividends out. Consequently, the companies retain the money, which increases the share price. The Australian graph I've got in front of you doesn't take into account the dividends that have been paid over the last 3 years, which historically would represent another 12 to 15% increase on the blue line. So you'd be pushing close to 140% movement in the market over the last 3 years. So that's not a bad outcome for Australia. It's certainly not a bad outcome for the USA. They're up 60% from the year before COVID. So again, portfolios are showing that, and I think most of you are aware of that. What we'll get going here now, sorry, I want to look historically. This data is a graph many of you would have seen before. It goes back to about 2008-9, when the US government, in response to the global financial crisis, started printing money. Quantitative easing is the jargon word for the government prints money and pushes it out into the market. Now, I'm going to show you mechanically how that happens later, but it inevitably results in the stock market growing. So this is a pattern we've seen in 2009, 2011, 2013 through to 15, and we're seeing it again now from 2020 onwards. There's a fancy word they use for it. It's called modern monetary theory, which basically means that inflation is largely under control because of the effect of technology making everybody more efficient, and the outsourcing of production from Western world to the third world, which is having a very positive effect on markets and productivity in the economies. But short version is, at the moment, printing money hasn't really caused inflation, and has certainly caused recovery in share market and stock market. Now, if you can just, sorry, I've got someone at the door there, and if I have to, I'll mute myself and talk to them. We're going to hear a lot of noise over the next 3 to 6 months about inflation. The media will do what it always does and try to scare the pants off us and tell us that it's a big drama. I'm going to show you a bit of history and show you why you shouldn't really need to worry about it. The truth is, inflation has some benefits. Not so much if you're a first home buyer, because property prices going up is one of the strong benefits. So we're going to have a look at that now. When we talk about inflation, it's not quite as simple as it seems. The Consumer Price Index is inflation as it affects the average person in this country. The average person buys goods and services. Thanks for that. The average person buys food and beverages, pays for houses, pays for petrol, buys clothes, and spends a bit of time taking holidays or looking after themselves medically. That's the Consumer Price Index. The governments of the world don't necessarily, and I think they're right in doing this, they don't necessarily agree that what affects the consumer is a universal measure that you can use to govern whether the economy broadly is paying more for goods and services. So what does it cost to live in the capital city versus a rural environment? What does it cost for a business to run? Right? 50 to 60% of all business costs are wages. So in this country for the last 5 years, we haven't seen any wage inflation. So business expenses haven't gone up that much. And particularly in a falling interest rate environment, the cost of running a business with borrowed funds is reduced. Is it more expensive to run the government than it used to be? Again, not as much as you would think, because wages haven't gone up, which is a very large part of their economy. So there are many things that will define what inflation is, but the three drivers of the economy are consumers, business, and government. And so the truth is, inflation isn't necessarily happening to the extent that the media is going to portray it's happening. On the flip side, too much inflation obviously is a bad thing, because it becomes expensive to run your family or run your business or run your country. But a little bit of inflation is relied upon to keep the value of our super growing, to keep the value of our wages going, to keep the value of our house increasing. But we've got to figure out how much is too much. And this is part of the equation that we need to look at. So I'm going to show you some figures in a little while. But the government in this country has targeted 2 to 3% as an inflation rate. So if you go back to the 1950s, inflation typically wobbled around between 0 and up to 10%. We all remember those days from the 70s through the 90s when interest rates were up around 18%. So higher inflation will typically mean higher interest rates. Just let someone else in here. Now, since the 1970s caused so much by the way of boom and bust, from about the 1990s onward, the governments of the world targeted a band. They wanted 2 to 3% inflation rather than 4, 5 or 6% inflation. And as a consequence, things calmed down quite a lot. We started to see a lot more consistency in the economy, but most importantly, we stopped seeing the boom and bust cycle. Everyone here should remember the recession we had to have, right? Which was the last one in the 90s, where Paul Keating was suggesting that we needed a structural adjustment in the economy. We've got to change the wage environment. We've got to change the way we do business a little bit. And that was the bust, followed by the what you call the Clinton years, where the economy under Howard and Costello and all that sort of stuff started to become more predictable, which is why we had 28 years of steady economic growth, which was the record in the world. Australia has really done well. Now, the government via the RBA will use interest rates and printing of money to keep inflation in this smoother band. Now, in America, it's slightly different, and we need to recognise Australia's economy is about 1.6% of the world economy. The American economy, if, as the old phrase is, America sneezes, we catch a cold. So what's going on in America will affect the cost of money here in Australia and will affect the economy in Australia. In the US, in August 2020, post-COVID, they started talking about, instead of managing to inflation to a band of 2 to 3%, they started talking about managing inflation, average inflation, in a band of 2 to 3%. Now, for the preceding 3 years before COVID hit, we saw an environment where inflation was a 1 to 1.5% in America. Now, they like things growing in value because it keeps the economy tickling over. So America has very deliberately targeted an expanding economy very quickly and is willing to tolerate higher inflation so that the average looks good. But that's done principally because governments don't want economies to shrink. They want economies to grow because it makes the government debt look smaller relative to the size of the economy. So this is a very busy graph, but the short version is it shows inflation on the dotted line on the bottom against the cash rate in red above it. But more importantly, the squiggly lines above it are the house prices in all the major capital cities. Now, I want to point out here that that's a pretty steady growth in house prices from about 250,000 to 1.2, 1.3 million now in Sydney, if you look at the green line on the top, with a variety of recessions along the way. This very thin recession here is what they're calling the virus recession or the COVID recession. It's really not like the others. If you look back to the 70s, you see a very regular boom-bust cycle. Any period in grey is a recession, the economy's going backwards. Recession defined as two quarters of negative economic growth, meaning you earned $100,000 last year. This year you earn $99,000. That means you're in a recession. Now, any of us know that that's not that big a drama, but the way the media reports it, you'd swear that we were losing a limb. Now, what we've got there is a very steady boom-bust cycle. You can see it. And from about 1990 onwards, after the recession we had to have, we have seen very clearly far fewer recessions. We had one in GFC, but it wasn't even a recession in Australia. That's an American recession, really. Now, the interesting piece here, under the heading of "Is too much rock and roll a bad thing?" the recessions were strongly correlated with falling property prices. Okay. The bad thing about too much boom bust, high interest rates, low interest rates, is it really does have a bad impact on property prices. So this is the one that we need to be concerned about a little bit. Because if we get too much inflation, they're going to raise interest rates to slow it down, because inflation is uncomfortable when it gets past 5 or 6 or 7%. So they'll raise interest rates to slow it down. What that does is it makes it more expensive to borrow money and buy a house, borrow money and buy a business. Consequently, you employ fewer people, you don't invest as much in property, and people don't feel as wealthy. So very much in a situation here where we don't really want the boom bust. However, there's a lot of reasons to think that's not going to come. Now, just a quick look at the share market. I struggled to find any Australian share market graphs from 1970 onwards, so I had to go back to 1900. But again, this graph is what's called a logarithmic graph. If you look at the actual graph, it's a very steep curve. What's happened here is that during the inflationary years, high interest rates, high inflation was very good for the share market. Now, why am I showing you this? Because decent inflation is good for property. Decent inflation is good for the share market. Both of those are good for retirees and investors. Boom bust makes it expensive if you're a negatively geared property investor, if you're borrowing money and going into the market. However, as a general rule, what I'm telling you is higher inflation equals higher interest rates, which broadly speaking in the long term equals higher returns for property investors and share market investors, which means Australians, because we have so much money invested through super, are going to do well in periods of higher interest rates. Now, let's have a bit of a look at this. When we're talking about inflation, the government wants 2 to 3% inflation because it means that the economy is growing. They don't want 8 to 10%. So what their job is, they call it fiscal policy, which you hear about in the media all the time. Basically, it's taxing us and spending the money on things. So the spending of money or the collecting of money. They save in the good years. We don't see that much anymore, but they borrow money from the market and they spend it in the bad years to stimulate the economy, which is exactly what the last 2 years has done. Right? The last 2 years has seen the government spending money to keep the economy afloat. It's what they're there for. The Reserve Bank's job, the Reserve Bank controls what they call monetary policy, which is whether interest rates are up or down, whether money is issued to the economy or not. So lower interest rates are used to stimulate the economy. We know that. That's the first thing they did when COVID hit, was cut interest rates to basically zero. Higher interest rates are used to slow things down. So as the Americans talk about inflation, and you will hear the word hyperinflation, I doubt you're going to get hyperinflation in Australia, but you will hear the media talking about it because that's how they get you to look at the screens. As we see higher inflation coming in, we're going to see interest rates tending upwards. Now, that has a consequence, which I want to talk about, but there's reasons not to get too stressed about it. In fact, I see the next 5 years as inherently very positive. I think we're going to have one bad year in the next 5 years. It might be the next 12 months. I'm not sure. I don't think it will be, but expect one bad year in the next 5, I think, and you won't be far wrong. Now, the Reserve Bank also, via the government, dictates a bit of policy about how well the banks lend money out into the economy. So when we talk about the market, the market is all the different people in the economy that have money and lend money to the government so that the government can spend it to stimulate the economy. They lend that money via a mechanism called a government bond, and the market will also lend money to business and consumers, which is what the banks do when they lend us money. Now, government bonds are essentially a term deposit with the federal government or the state government. Sorry, I shouldn't say the RBA there, it's with the state government. Now, the government will borrow money from you in periods of 90 days up to 10 years. Bonds can be bought and sold by anybody, right? Unlike a term deposit. The government will pay interest every 6 months or every 90 days if it's a 90-day bond, just like a term deposit. Now, there is another entity here called the Reserve Bank of Australia. Now, I'll talk a little bit more about what they do, but it conducts the nation's monetary policy and issues currency. But the thing that you need to know, because it's different here to anywhere else and different to the US and some parts of Europe, the Reserve Bank is owned by the government of Australia, right? They act completely independently. They theoretically are not controlled by the federal government, but they are owned by the federal government as a company. It's the Reserve Bank of Australia Proprietary Limited. They are owned by the government of Australia, and that's important in terms of what happens now. So let's have a look at interest rates and how that impacts things. So say the investor somewhere lent the government $100 million at 4% interest. So that means that the government has to pay $4 million interest. If it was $100,000, that would mean you would be receiving a $4,000 interest payment from the bank when it's a term deposit. So it's sort of same thing, if you know what I mean. If interest rates fall from 4% to 3%, you're still going to get your $4,000 a year interest. Now, if you're getting $4,000 a year interest and you've got an environment where the interest rates are 3%, you would need to invest $133,000 to get $4,000 interest. So if you've put your money in at 4% and then they cut the interest rate the following day, you're pretty pleased with yourself. You've done well. You've locked the interest rate in at the right time. Does that make sense? If, on the other hand, interest rates are going the other way, which is what's starting to happen now, you only need $80,000 to generate that $4,000 interest payment. So when interest rates are starting to rise, you'll find the bond market doesn't do all that well. But again, let's remember what's going on here. They cut interest rates to stimulate the economy, and it does work. But they raise interest rates to slow the economy down because they think the economy is running a bit hot. But if the economy is running a bit hot, that means property prices are doing well. It means businesses are doing well, which means the share market's doing well, which means investors are doing well. So you get this slightly perverse effect where the bond market being negative actually sends a fairly positive signal to the investment markets that the economy is doing quite well. So in this instance, it's a sort of, mixed blessing, if you will. So depending on whether the bond matures in 3 weeks, 3 months, or 3 years, people will be willing to pay you a little bit more or a little bit less. So there's a variety of factors that govern that. But generally speaking, the bond market is a very good indicator of what the experts, and my mother, who's in this meeting, will remember my father used to say X is an unknown quantity and spurt is a drip under pressure. So you can't rely too much on the experts because they're paid to have an opinion. And in this case, that opinion is called an economist opinion. And the one thing that's certain is if you put 10 economists in a room, you'll have 15 opinions coming out. And I'm about to show you a slide that proves that. But one of the key things is that the bond market also tends to set the interest rate going forward. Now, I was talking to the bank the other day. If you went back 6-9 months ago, interest rates, fixed interest rates, were around 2.6%, 2.7% on mortgages. And Kate, the lady I was talking to, said the Reserve Bank raised, sorry, not the Reserve Bank, the National Bank in this instance, raised the fixed loan rate 3 times in about 6 weeks. And the reason they did that is this slide. Now, this is a US graph, but it still holds true here. The dark green or the green line is what actually happened to interest rates. The gold line is what the bond market thought was going to happen to interest rates. So the bond market in this instance was predicting and has consistently predicted that interest rates are going to skyrocket up. and they pretty consistently get it wrong. Now, there is one little section here where the interest rates actually went further. Somebody in there. Interest rates actually went a touch further than the market thought, which is this period here. But if you remember back a few slides ago, that was after 10 years after the GFC, 8 to 10 years of the government printing money to stimulate the economy. So guess what? When they printed money, the economy grew quickly. But very consistently, the experts overcook their forward estimates. So either going to be boom or bust. They're paid to have an opinion, they tend to overinflate it. But you can see here that when the predicted raising of interest rates during periods where stimulation is, interest rates are very low, which is now, we're very similar along this line, they consistently overcook it, very consistently. Now, that still doesn't stop the Reserve Bank the National Australia Bank from raising their fixed mortgage rate, which they did. But the comment I'd make here is that they tend to overcook it. Now, this is an interesting graph here. This is starting from January 2019. The Australian market inflation predictions. The light blue line is where they think inflation will go over the next 3 years. The dark blue line is over 5 years. The orange line is over 10 years. Now, we can see here that the consensus view here is that inflation is likely to go up about 0.5% from where it has been, pre-COVID, maybe 0.5 to 1%. Right? And that's because the government's stimulating the economy. When you stimulate the economy, wages rise and cost of everything rises, and away they go. But 0.5% is not hyperinflation. It's really important that you understand that when they start pulling the chain on this one and coming up to an election, they're going to start talking about it. During a period of 1 to 2% inflation, mortgage rates were 3 to 4%. So we're talking about raising the inflation rate by 0.5 to 1%. Mortgage rates will be rising back to 4 or 5%. But that's not 18%. I imagine most people in this room, even you and I, Rob, roughly the same age, can remember interest rates being high at around the 15, 17, 18%. We're not going to see that. We're just not going to see it. They'll still try to scare you, but we're not going to see it. Now, here's another graph I just wanted to show you. The orange line, orange bars, the Australian bond market. The blue bars are the Australian share market. You can see here this big negative, that's the global financial crisis. Now, I want to draw your attention to these 2 years. This was 1994, Russian bond crisis, and 1999, I can't remember the name of that crisis. But in both those years, they were periods where interest rates were moving upwards. They were moving in a direction that meant bonds were negative, because values were falling. Now, I want you to actually look here what's going on. After this year, we had 1, 2, 3, 4 positive years in the share market. After this year, we had 3 positive years in the share market. Now, we are right now coming to the end of a negative year in bonds. Now, historically, we're only going back to 93 here, but again, come back to this idea. When interest rates are rising, that means the government thinks the economy is going too well. That's a period during which investors should see good returns. So if you go back in Australia over the last 30 years, the only 2 periods where bond returns were negative resulted in some very positive years for investors. Now, they don't normally go negative. So most of the time, bond yields are actually somewhere between 1, 2, and 3%, 4%, 5%. But we have had a negative year. That first thing it teaches me is don't get out of bonds. They're likely to do okay this year. Secondly, is the share market's likely to do okay. Now, this is why I said earlier, I think we're having a 4 or 5 good years coming. We're probably going to see 1 bad year because that's what happens. Right? And if we look here at a historical graph of, I think this is a US graph again, but it's worth looking at. Historically, you get positive years or bull years, which is any period during which the market increases by 20%. The black years are the years where it falls by 20%. So we had a little black year there for 6 months, mid-COVID. We've barely started our positive return here. Now, can I tell you that with the next 12 months are going to be positive? No, you've all been around long enough to know I can't do that. Can I tell you that based on history and based on everything that I understand about inflation and the bond market and the share market, and the fact that the government is printing money, should we expect to have good years ahead? The answer is yes. There is going to be some higher inflation. The kids are going to pay slightly higher interest rates on their houses. But historically, you should expect that we're going to see positive returns in superannuation funds and shares and things like that, as we have been seeing and as we are seeing in property sectors as well. Now, does anyone have any questions at this point? Mitzi, I'll just unmute you. Hang on. I have to ask to unmute you. Yep.
I'll unmute myself. Will this depend on who gets in when the election does come?
Look,
how much does that affect this
historically, I'm a fairly conservative sort of person. I've voted Liberal and Labor many times over the years. Historically, no, it doesn't really, right? The only thing that would be crazy is if some of the green policies come in and they start shutting down coal mines and closing down the energy industry in this country, which I think they'd be rather stupid to do. And they Labor lost the last election in Queensland over that thing. The answer is probably no, because this stuff is run relatively independently of politics. So whilst a Conservative voter may not be comfortable with Labor getting in, historically they haven't. The presence of a Labor or a Liberal government doesn't tend to affect the behaviour of investment markets that much. Okay. Now, I want to explain something because it's going to come in the media. You'll have heard it a little bit over the last year or two. The growing government debt crisis. And Australia is slightly different to the rest of the world, as I said. But the way the government debt works in this country, the Australian government goes to the bond market and says, I need $100 million or $500 million to run the business of government, and I will pay you interest on that. And that's the Reserve Bank rate. The Reserve Bank tends to set those rates, right? And I'll pay you 2% or 3% or 1.5% interest. And then all of these different players, you know them, the banks in particular, but super funds as well, overseas banks, everybody, they will buy and sell government bonds in the bond market. They will receive their interest payment, and when the bond gets to the maturity date, just like a term deposit, the government gives their lump sum of money back. So that's how it works. It's effectively like trading term deposits, and interest is paid every 6 months. So that's a normal year with no quantitative easing. QE is the fancy word that the experts use for printing money, right? Now, in years where the government wants money issued, so the Reserve Bank prints money, it literally just makes it up on the computer. It doesn't physically print it, it just issues it. $1 billion here and $1 billion there, and soon you're talking about rather a lot of money. What they actually do when they print money is they go to the bond market and they buy bonds. Now that has a couple of effects. It drives interest rates down. If you go back to the slides a little earlier, so they pay a slight premium on the bonds and pushes interest rates down. But it also means that Combank and Westpac and ANZ have suddenly got $500 million they didn't have yesterday, because they're in the business of buying and selling investments. If someone offers you a good deal, they take it. And now they've got a bucket of money they've got to do something with. So what they do is they take that money and they go and lend it to you and I. They go and lend it to businesses, right? Or they may go back and lend it to more government bonds and things like that. But what actually is going on here is the Reserve Bank has bought the government debt from the market. So now the Australian government pays interest to the Reserve Bank of Australia, right? Okay, the government's still paying interest. How does this solve the problem? I want to remind you who owns the Reserve Bank of Australia. So when the Reserve Bank of Australia makes a profit, it gives the money back to the government. Now, I bought a car a year ago, right? And it's a nice car, and it came with GST attached because I bought it from a dealership. So one of the things that you can do when you own your own business is if you've got enough money, you can have another entity lend money to you to buy the car. Right? So instead of borrowing it from the bank, I borrow it from myself, as it were. We've just got this trust over on the side. Now that trust got the GST back. But on paper right now, I owe $60,000 or whatever it is, $50,000 on the car, but I owe it to myself. I'm not 100% sure it's a debt. The government can say, yes, I have a debt, but at the moment, the government owes money to a company that the government owns. So it's called an off-balance sheet transaction. I won't go into the details, but the short version is Australia has a funny position where by printing money, the government is buying its own debt back. Now, longer term, that causes inflation. It really does cause inflation. We've talked about that. But it doesn't mean the government of Australia is going to get broke. Right, so we get in a funny position. Now, some countries aren't really able to issue their own debt, e.g. European countries. Their own debt is actually owned by the European Central Bank. So if France, borrows money from the market, that's a different thing because literally the European Central Bank is not solely owned by France. But in Australia, the Reserve Bank is solely owned by Australia, which is a very positive story. Now, I just want to get into some numbers. Now, this is going to get a little bit statistic heavy, but I was so pleased to find these numbers because it really is very cool where we live. So I was doing a bit of research, trying to look at inflation, which is the number on the right-hand column. Now, there are 205 countries in the world, but most of them are much, 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 much smaller than Australia. So Australia, here, we rank, I think, about 14th out of the top 16 countries. There's only 16 countries whose gross domestic product, or GDP, this is the left-hand column here, is the total income for the country, what we buy, what we sell, the ins and outs in the economy. Australia is roughly $1.3 or $1.4 trillion in money moving around the economy, right? Our inflation rate's 3.5%. There are or America, where it's 7%. Now, American inflation rate is 7%. That's where you'll hear the word hyperinflation. You will hear the media talking about inflation in Australia as if it's a death knell. It is not a death knell. It's just not a death knell. Now, this table, I know it's a bit complicated, but I want to explain a few things here. Gross domestic product per person is the income each Australian sort of earns, taking into account the income that companies are earning and assuming that it's coming back to the individual person. Australia earns almost $52,000 per person in gross domestic product. Dollars debt per person, this is government debt per person. On average, we owe $12,800 per person, right? Deficit per person, that's the government deficit, is when they're overspending, right? When they spend more than they've got, and that's why they have to go and get bonds from the market. On average, the government spends $2,200 more per person than it earns. Debt as a percentage of GDP, in Australia, we've got one of the lowest in the world. Our government debt relative to the turnover of this nation is phenomenally low. The only country lower is Russia. And to be blunt, I don't want to live in Russia. I don't want the life they've got. The next one is what they call the deficit GDP per person. Our government overspend per person in this country is very, very low as well. And then you have inflation. Now, I want you to look at this box right at the top. Australia is consistently, when you look at the income we earn or the debt we earn, Australia is almost the best in the world in most categories. So just to look at the numbers, if we look at any country with a turnover, a gross domestic product equivalent to ours, which is more than 1 trillion, there's 3 countries below us on that list, but let's just say that's comparable, right? We rate the second highest in the world in income per person. America's higher, right? We have the second lowest government debt in the world per person. Russia is slightly better. We have the second lowest debt as a percentage of national income in the world. Russia is lower because they got very low debt. We have the second lowest debt divide per person, taking into account income in the world compared to Russia. We have the third lowest government debt per person in the world by comparison to Russia and China. But that's out of 205 countries. It's just so important to understand. I was explaining this to my daughters the other day. It's like the World Surfing Championship, right? To be number 1 in the world, you don't have to win every contest. What you've got to do is be second or third or fourth in every contest. Because just because someone beats you in one category doesn't mean they're better than you. When you've got to have a fairly broad number of categories to look at the economy. And what you want is for your economy to be thereabouts in the top 5 in all the categories, makes you the strongest economy in the world. Now, we're 5th lowest in the world in inflation rates. So are we the lucky country? The answer is hell yes. Right? This is if you'd rather be here than anywhere else. The prospects for this country, you've heard me talk about it before in terms of where the next 50 years are going to go, are fantastic. But the starting point, where we are today, we are not in a mess. Don't let the media scare you. Do we have work to do? Yes, we do. And I can't help myself. I do want to compare ourselves to the other countries. Excuse me, I should have that turned off. By comparison to other countries, there are many countries with less debt than us. There are many countries with more income than us. Actually, no, there's only one country with more income than us, but they don't compare to our economy. I don't want to live in Saudi Arabia. I don't want to live in Russia. I don't want to live in New Zealand. I like going to New Zealand. I don't want to live there. I don't want to live in the Maldives, right? They've got some good numbers, but when you compare them to Australia, and I did this with my wife this morning, trying to figure out, okay, where else might I live? If I didn't want to live here, where else might I live? And I came up with USA, Britain, France, Canada, Australia, and New Zealand. And I threw the Maldives in just because everyone wants to live on a tropical island once, right? But when you start looking at the numbers, whilst the Maldives has lower debt per person, they also don't have hospitals or roads, right? You live in a grass hut. Whilst New Zealand has some fantastic scenery, their income is lower than ours. Their debt's comparable to us, but their debt to GDP ratio, you know, America, like New Zealand isn't spending a lot of money. Their economic growth hasn't been very strong in the last year, if you look at that figure there in the third column. Canada, a place that you could compare to Australia, resource rich, their income is comparable sort of ours, about $43,000 a year. Their debt per person is 4 times worse than ours. Their government debt is 4.5 times worse than ours. Their government overspend is 4 times worse than ours. Their inflation rate is significantly higher. That's the same when you look at France and the UK. The UK is obviously comparable, right? Their income per person is pretty good, but it's not as good as ours, and the weather's not as good, right? Their debt per person is 3 times higher than ours. Their average government overspend is 3 times higher than ours. Their inflation rate's significantly higher than ours. Their government debt is 4 times higher than ours when you look at the size of the economy. The Americans, their government debt is 5 times higher than ours, even though they have higher income. So there's lots of reasons why it's more difficult to live in those countries than it is to live in this country. So do we live in the lucky country? Hell yes. Should we be proud of what we've done? Yes. Are our politicians annoying? Yes, they are very annoying, but they're not actually screwing it up. And please don't let the media scare you. We're going into a period where a lot of overseas information, e.g. the 7% inflation rate in America, is going to be in our media. They're going to use the words hyperinflation. That won't come down here like it did 30 years ago in the 90s. We will see interest rates going back to 4 or 5%. We will see 4 good years out of the next 5, I think. You know I can't control that, but that's my opinion. We will have a better life in 5 years' time than we do now. Your grandchildren may need to buy second-hand furniture and second-hand cars and live in Curry, not Merewether. You know, the cost of property is going up. Guess what? They may have to actually do what you did when you were younger and, you know, compromise a little on their first home. It's not something they're very good at doing. But we have 1 million immigrants wanting to come into this country, and the government's about to open the borders. Those immigrants will create 1.1 million jobs when they come, and we simply won't have enough people for the jobs. So that's going to cause a bit of wages pressure. It will certainly cause housing price pressure. So I'm fairly positive about the housing market over the next 5 years. I'm positive about the share market over the next 5 years. There will be shocks, there will be ups and downs, but I'd rather live here than anywhere else. And even though I like to complain about politicians as much as anyone else, they're actually not screwing it up. They're doing okay relative to the rest of the world. So that pretty much finishes it, unless anyone has any questions. Does anyone want to ask anything either via the chat box or put your hand up? I can't see a lot of video here, so I'll stop the screen share so I can see some of the video. But failing anyone asking any questions, I'd wish you all well. Take care and God bless. Now, one other thing that I'd invite you to do, we're crafting a series of 3 to 5 minute videos that we're putting up on our website as well, that we're trying to just give clients and new clients an opportunity to see some basic information about Centrelink or tax, or what it's like when they come to see us. You've all had that experience. But what I'd like to know, if you have any thoughts, if you do want a 3-minute video to educate you about aged care or the government or inflation or about bond markets or about super contribution rules or about how to help your grandchildren start their first investment. I was talking to a friend of mine yesterday about that. Please send in any emails or give us a ring and say, hey, can you do a 5-minute video on this? Can you do a bit of information for me about that? We're trying to create a bit of content that's on our website that we can email to people and so forth, that hopefully will help people understand something that's bugging them a little. But failing anyone asking me any questions, I wish you all the best, and I will see you soon.
You too.
Take care.
You too. Bye.